Okay, let's dive right into this explainer. Today we're looking at Constellation Energy, ticker CEG, and how they are positioning themselves right at the explosive intersection of AI data centers and the American power grid. If you've been watching the tech sector at all lately, you know that artificial intelligence is driving unprecedented demand for processing power. But here's the unavoidable physical reality. That processing power requires actual, physical electricity. So we're going to dig into the source material, from their recent Q1 2026 earnings all the way to their regulatory filings, to understand exactly how Constellation is navigating this massive structural shift.
We've structured this explainer into 5 distinct parts for you. Number 1, AI's massive power problem. Number 2, Constellation's clean energy moat. Number 3, a free cash flow explosion. Number 4, regulatory roadblocks and risks. And finally, number 5, the final investment verdict. Let's get into it.
Section 1. AI's massive power problem. Let's start by pinpointing the absolute macro bottleneck facing the tech industry right now. You see, it's not just about getting your hands on advanced chips anymore. It's about finding a place to actually plug them in. Hyperscalers, think your major cloud and AI providers, are literally desperate for power to run these AI models. But getting that energy routed through the traditional grid is plagued by congestion and line losses. As we saw in the earnings call transcripts, managing this explosive demand growth while the physical grid is under extreme duress is basically the defining challenge of the decade. The legacy public grid, which is heavily reliant on localized weather patterns and intermittent renewables, well, it simply cannot handle a massive data center that requires 99.999% uptime. I love this quote because it hits the nail on the head. It perfectly illustrates the solution: behind-the-meter co-location. Basically, data centers are being built directly at the power plant to completely bypass those macro grid fees. By netting the load behind the meter, power producers avoid the non-bypassable transmission and distribution charges that historically plague large industrial loads. You're essentially treating the data center as a highly predictable, localized draw right on the power plant itself.
Moving on to Section 2, Constellation's clean energy moat. What's really fascinating here is how Constellation isn't just participating in this market, they are structurally dominating it. They are actually the largest private sector power producer in the entire world. And what makes their economic moat so incredibly deep is their nuclear fleet. These plants consistently run at a massive 92.3% to 94.1% capacity factor. That offers perfect baseload reliability. While wind and solar naturally fluctuate with the weather, nuclear provides the firm, zero-carbon, around-the-clock power that these AI data centers absolutely demand.
And this isn't just some future promise either. They're executing on this right now. They absolutely crushed Q1 earnings estimates despite the extreme duress on the physical grid. They reported adjusted operating earnings of $2.74 per share, which is a massive 60-cent jump from the first quarter of 2025. Plus, they confidently affirmed their full-year guidance of $11 to $12 per share, really proving that their operational excellence translates directly to the bottom line.
Now, to really understand their recent $26.6 billion acquisition of Calpine, we need to look at the operational differences at play here. It's steady, high-capacity, zero-carbon nuclear versus rapid-response peaking natural gas, like Calpine's new 460-megawatt Ping Oak Creek facility in Texas. While nuclear runs continuously, a peaking facility is designed for raw, immediate response. It can fire from a cold state to full load in literally minutes to capture extreme pricing volatility whenever system demand peaks. By adding Calpine's massive fleet to their portfolio, Constellation is pairing its firm nuclear base with the largest natural gas and geothermal operations in the country. They're adding 27 gigawatts of capacity. And remarkably, even with this heavy natural gas addition, they're maintaining a highly impressive 59% zero-carbon energy portfolio. They are effectively aggregating the exact intersection of firm baseload and rapid response peaking power that the modern grid so desperately needs.
And as you'll see, this operational strength translates directly into real-world contracts. They're locking in massive deals with retail giants and hyperscalers to deliver bespoke power solutions. For instance, they just secured approval from the Public Utility Commission of Texas for a 380-megawatt net metering application for a Cyrus 1 data center, co-located right at their Freestone site. Add to that bringing the 105-megawatt Pastoria solar project online for California and signing a 15-year nuclear power purchase agreement with Walmart. They are stacking up the strategic wins.
All right, Section 3, a free cash flow explosion. Building out all these custom substations and upgrading plants requires immense capital.
But Constellation's financial projections here are just staggering.
We're looking at a jaw-dropping 45% step-up in projected free cash flow by the end of the decade. For 2026 and 2027, they're projecting $8.4 billion prior to growth investments. But the true inflection point? That arrives in the 2028 and 2029 window, generating anywhere between $11.5 and $13 billion. This is cash generation at a historic rate, driven heavily by forward pricing curves and the integration of those acquired retail margins.
And what does that mean for shareholders? That translates to $5 billion, which is the massive share buyback program the board just authorized. When you have an expected $13 billion in cash coming in, capital deployment discipline is absolutely everything. Management didn't just sit around, they authorized this buyback to provide maximum flexibility, and they've already started executing portions of it.
They are using this massive liquidity to defend their equity valuation against any potential technical selling from legacy Calpine owners, rather than just pouring concrete for the sake of growth. Management emphasized a really rigorous returns-based discipline. They demand double-digit returns on any new physical asset development before even accounting for debt. If pouring concrete doesn't meet that strict hurdle rate, well, they will just step in as the buyer of last resort and retire their own shares at what they view as a compressed multiple.
But look, Section 4. Regulatory roadblocks and risks. It is definitely not all smooth sailing. It's absolutely vital we impartially examine the friction points that could choke off this growth.
Because Wall Street has definitely punished the stock recently. Over the past year, the stock dropped 24.4%, actually lagging the broader alternate energy sector's 21% growth. Why? Well, investors are quite concerned about the debt taken on from the Calpine deal, potential share dilution, and this incredibly complex regulatory gridlock that is slowing down new connections to a crawl.
To try and bypass these bottlenecks, Constellation is attempting a highly technical regulatory maneuver. Basically, they're trying to port dormant capacity interconnection rights, or CIRs, from their Eddystone plant directly over to the retired Crane nuclear facility in Pennsylvania. If the Federal Energy Regulatory Commission approves this masterclass in regulatory optimization, they'd unlock full capacity credit revenues for the 800-megawatt Crane plant by 2027. And the kicker? They do it by completely bypassing the massive network upgrades that are usually required for new connections.
And honestly, this maneuver got a major boost recently. The Nuclear Regulatory Commission cleared the draft environmental assessment for the Crane restart, keeping them on track for a final decision in 2027. The NRC explicitly stated there are no significant environmental impacts to bringing this 800 megawatts of electricity back to the grid. That clears a massive federal hurdle without unnecessary duplication or delay. Yet, despite that win, they still have the equivalent of 5 full nuclear reactors, 5,000 megawatts, stuck waiting in the regional grid's interconnection line. Regulators right now are fiercely debating whether data centers should have to pay discriminatory grid fees or if overarching system costs should just be shared across the board. Until this regional gridlock gets resolved, billions of dollars in sidelined infrastructure capital is just going to remain paused. Okay, Section 5, the final investment verdict. Let's pull all of this macro and micro data together into a clear picture of the company's underlying value.
So the multi-billion-dollar question: is Constellation Energy ultimately worth your investment capital right now, especially when you weigh the 24% dip, the massive AI tailwinds, and that sticky regulatory gridlock?
Well, when we look under the hood at the fundamentals, the picture is incredibly strong. Constellation has a vastly superior return on equity of 16.81% compared to the industry average of just 7.15%. That means they are using shareholder funds highly efficiently. Furthermore, their debt-to-capital ratio sits at a manageable 43%, which is much lower than the industry's 55%. And perhaps most surprisingly, despite their dominant market position, they're actually trading at a significant discount right now, a forward PE of 18.86 versus the industry average of nearly 25. Add to that the fact that the government is essentially guaranteeing a revenue floor via the Inflation Reduction Act's nuclear production tax credit. That means their baseload fleet's economic viability is structurally protected even if wholesale power prices were to suddenly collapse. Driven by this downside protection, management projects long-term earnings growth exceeding 20% through 2029. Balancing that immense AI upside with the Calpine integration risks, analysts at Zacks currently give the stock a solid hold rating for long-term investors. So I'll leave you with that provocative thought to consider the next time you're reviewing your portfolio. When you strip away the flashy software, the cloud interfaces, and the algorithms, it all entirely relies on a physical plug connected to a firm zero-carbon grid.
Thank you so much for joining this explainer, and we will see you next time as we continue to break down the complex forces shaping our markets.